Hi everybody, this is my screencast for Chapter 2. What Chapter 2 talks about is tax compliance, the IRS, and taxing authorities, how to do research, how to write a proper tax memo, things that might come in handy for you as you get into your tax practice and think about things like that. But I'm going to try and abbreviate some of the things that are covered in the chapter because I don't think they necessarily apply to you at this point in your career. So, with that said, I want to start with talking about filing requirements and filing tax returns for individuals. Now, there are many of you in the classes that I have that are CPAs, that are tax experts, that you have experience in this, so you'll be familiar with it. But there are also some of you who don't have any experience in doing taxes at all, and so this will be new information for you. So what we'll do is we'll walk through this together and talk about the things that I think are relevant to you in terms of taxes, preparing taxes, and those types of things. Okay, so this is what we're going to be talking about for Chapter 2. So first thing I want to do is talk about filing requirements. I threw in Bill Murray because I thought Bill had a funny saying about the best way to teach kids about taxes is by eating 30% of their ice cream. Bill's probably right about that. Okay, taxpayer filing requirements. When do you have to file a tax return? Well, if you're a corporation, all corporations have to file regardless of taxable income. They don't have a choice. It's absolutely mandated that they file a tax return every year. Estates and trusts are required to file if gross income exceeds $600. And that's not very much when you're talking about estates and trusts, so they also have to file at that $600 point. Now let's talk about you. Let's talk about individuals. Okay, how do we decide if you have to file a tax return? For individuals, filing's determined by your filing status, your age, and your gross income. So what do I mean by those three things? Or what does that look in the IRS tax manuals about who has to file? Here's an example of the 2016 gross income thresholds by filing status. So let's take, for example, somebody that's single. The easiest one that I can point out to is somebody single, the very first one. Okay, gross income has to be in excess of $10,350 to require a single person to have to file a tax return. Where's that number come from? Where did they get that? Well, basically all they did is they took the standard deduction for a single person, $6,300, added in the personal exemption of $4,050, and that's the number that they came to. If you're 65 or older, you get the same treatment as far as calculation, but you also get the $1,550 additional deduction for your age, being 65 or older. So your basic threshold is $11,900. And you guys can see as you go looking at the thresholds by filing status, as it rises for each group as you go through it, that explains to you what is the basic threshold for you if you have to file a tax return. Now, here's something not necessarily for you guys, but if you start dealing with clients and start dealing with tax clients, they will get confused by these two things. They get confused by when do I have to file and what about my refund? I don't get it. Aren't those two connected somehow? And I can't tell you how many clients I talked to and had to explain to them the difference between the requirement to file a return and the idea of getting a refund. With thresholds that change every year in terms of filing requirements, the filing requirements are indexed to inflation. So every year those numbers are going to change, and I think that adds to the confusion that your clients will have, because what you told them last year as far as filing requirements that they needed to have in order to have to do a return will change annually, and that also is confusing for them. So what I want to make clear to you is that refunds and having to file are different animals, okay? That sounds really basic, that everybody should know that, but they don't. Refunds happen when the taxes that you pay are greater than your tax liability. So after you've done your return, you figure out what your tax liability is, you look at what your taxes are that you've paid into it, and if the taxes that you have paid are greater than your tax liability for this year, then you're going to get a refund. And how do you figure that out? Well, gross income dictates whether you have to file a return or not. I just showed you the example of what calculates to meet the threshold for filing a return. And here's my point. This is another tip for you, and maybe even the tax professionals that are in the class. They probably know this as well, but it's something good to always keep in mind. Even if your gross income is below the threshold for you having to file a return, you can still file a tax return. And you should do that if you feel like you deserve a refund or you're going to get a refundable tax credit. Okay, so I'm going to say that again, that even though your gross income is below the threshold, if you think you're entitled to a refund, if after you do your taxes it shows that you have a refund coming or you get a refundable tax credit, then I would absolutely recommend that you file so that you can get that money back from the government. Okay, so that's the idea behind filing versus refunds. Filing a return is different than getting money back, getting a check from the government. Okay. Now, let's talk for a second about this. Is something that I want to throw in, the difference between refundable and non-refundable tax credits. Because again, this might be an area that you're not really aware of, but that tax credits, first of all, when you think about tax credits, why are they good? Tax credits to me are better than deductions. To any tax professional, I'd rather have a tax credit than I would a deduction. Why? Because tax credits lower your tax liability dollar for dollar. And so they put money in your pocket on a dollar for dollar basis. Every dollar that you save on your tax is a dollar in your pocket if you use tax credits. Now, tax credits are divided into two big categories. They're divided into refundable and non-refundable tax credits. When a tax credit is refundable, that means that even if your tax liability is zero, even if it's zero, you'll still get a refund check for the credit. Okay? So again, let me emphasize that even if your tax liability is zero, with a refundable credit, you still get a check back coming from the IRS. Now, a non-refundable credit is different. A non-refundable credit will help you lower your tax liability to zero, but at that point, that's it. You don't get a check from the government for a non-refundable credit, but you do for a refundable credit. So I want you guys to understand the difference in those two things. I threw up a short slide at the top of this that talks about what non-refundable credits are out there. And refundable credits, again, you can look it up and see the ones that are available to you and what it might apply to you. Again, of course, as you would expect with the government, there are specific rules for when you're entitled to a refundable credit or when a non-refundable credit might apply to you. And those you should do some research on if you think those are available to you. But I just wanted you to understand the whole concept of tax credits. Okay. The next thing that we're going to talk about are tax return due dates. When's your tax return due? Okay, that's my quiz for the day. How many of you guys can tell me April 15? Okay, most of you? Good. When's a corporate tax return due? Oh, how many people can answer that question? I wish I could see a show of hands. How many people can tell me when a partnership or an S corporation tax return is due? Again, I need to see a show of hands, which I wish I could see. Okay, so let's talk about it. When do you have to file your return? For individuals, you file your tax return on the 15th day of the fourth month, which means what? April 15th, following the end of the tax year, you have to file your return. So let's say for 2017, for example, when is your tax return going to need to be filed for 2017? The tax year for individuals ends on December 31st of 2017. So on the 15th day of the fourth month, or April 15th of 2018, your return needs to be filed, unless that falls on a holiday or a Saturday or Sunday. Then you get the next regular business day. How about C corporations? And if you don't know what a C corporation is, think of it, and we'll talk about what we'll get clear as we go through the course on what C corporations are. But in general, at this point, if you don't know, a C corporation is your standard corporation. There's nothing special about it. There's nothing special as far as how income is treated or expenses are treated. The corporation, think of it as if you guys had your business law class, a corporation for law purposes is treated as an entity, as a living entity. And so a C corporation as an entity in itself has to file by the 15th day of the fourth month following the end of the tax year. Okay? So C corporations generally the 15th day of the fourth month following the end of the tax year. Now, why it sounds just like individuals, right? Well, the difference is that C corporations won't necessarily have a tax year that ends on December 31st like individuals do. C corporations can pick their tax year. They can elect to have a tax year that's different than just the annual year or the normal year. And so this explains to you that whenever that is, whenever you've picked by the 15th day of the fourth month following the end of whatever your corporate tax year is, you have to file your return. Okay, partnerships and S corporations. Partnerships, for some of you, you might have a rough idea of what a partnership looks like, and for an S corporation, the same thing. But I'll explain those to you as we go through the course and how they work. But again, when do they have to file their tax returns? By the 15th day of the third month following the end of the tax year. And again, they don't necessarily have to have year-end tax years for this to be applicable, although most S corporations, many partnerships, almost all of them will have an annual or a normal annual end of their tax year in December, but that's not necessarily a universal rule. So what this says is by the 15th day of the third month, a partnership and an S corp has to file the tax return. Okay? If, as I said earlier, if due dates are on a Saturday, Sunday, or a holiday, it's extended to the next business day as to when it's due. Also, something else for you, and this happens a lot. Individuals, corporations, and partnerships are allowed to apply for automatic extensions. Okay? You can apply for an automatic extension for a period of time to let you get your return done. Now, what happens? Here's something to keep in mind. Yes, as an individual or a corporation or a partnership, you can apply for an extension, but the government requires you to still pay your tax on the required time. So what that means is you're going to do a rough calculation, you're going to do an estimate of what you think you owe in taxes, and you're going to send the government, if you think you owe, you're going to send them a check anyway at the regular date. Now, during the time that you're allowed your extension, you figure you're due a refund or whatever, you can apply for that. But the government's not going to give you a pass on actually paying your taxes. So even though you don't have to file your return for a period of time when you ask for an extension, and normally an extension is 6 months, that's the typical way that an extension works. Their government's not going to wait 6 months for their money. If they think you owe or your tax estimate shows you owe, they want the money at the regular time. Okay, so that's something to keep in mind as well. So, statute of limitations. The next thing that I want to talk about, what's the statute of limitations? What does that mean? How long, in other words, in the statute of limitations, how long does the Internal Revenue Service have to come after you? If they feel like you have made a mistake, what's the time period when they can say, okay, we're going to do an audit of your return because we think you made a mistake and we're going to come after you for back taxes that we think you owe? The typical statute of limitations, where does it come from? What's the thinking behind it? Tax returns, as those of you that have been in tax practice for any length of time know, are loaded with incorrect amounts, reported either in the favor of the taxpayer or in the favor of the government, one or the other. But tax returns, because they are complex, there's a lot of rules to know and there's a lot of things that have to be applied to make them come out correctly. many times have errors in them, lots of mistakes, even with computers, because most tax professionals nowadays will use computers and computer programs. There's a lot of tax return preparation programs out there to do the returns, and they still make mistakes, and there's still errors made. Now, where are the errors? Many times the errors aren't necessarily in the calculations themselves, but in the interpretation of some tax event that happened during your year and how that's interpreted, and maybe you make a mistake on that interpretation, okay? Tax returns, the statute of limitation, you can file, the time in which a taxpayer can file an amended return, or the IRS can assess a tax deficiency, generally is in 3 years. So you have 3 years from the later of the date the tax return was actually filed or the tax return's original due date. Now that's a little hairy again, so let me explain it. Let me slow it down a bit to explain this to you. Okay, you've got a statute of limitations. Under the law, that means an open period of time when you can file an amended return, for example, saying I want some money back because there was an error made on my return and I'm entitled to more money. Or the IRS, the more likely scenario is the IRS will come after you for taxes because of some deficiency. They found an error somewhere in your return and they want to get paid for that time. How far can they go back to check you? 3 years is the typical time from the later of the date the tax return was actually filed or the tax return's original due date. The later of those two things. So let me see if I can give you an example here of what I'm talking about. Let's take a look at Bill and Mercedes. They're the ones in the story for this chapter. Bill and Mercedes filed their 2012 tax return on September 6, 2013, after receiving an automatic extension to file the return by October 16th. Okay? October 15th was a Sunday in 2013. What does their statute of limitations, when does it end for their 2012 tax return? Now remember what I said. I said that generally the statute of limitations goes 3 years from the later of the date the return was actually filed or the tax return's original due date. Okay? When does the statute of limitations end for Bill and Mercedes? The tax return's original due date was April 15 of 2013, so that's not the latest period. The latest period is when the return was actually filed. They filed the return on September 6th, 2013. So that's the later of the two dates, when it was actually filed or when it was originally due. So 3 years from then, September 6th of 2016 should be when the statute of limitation ends for Bill and Mercedes. And if we throw that up, there you go. September 6, 2016, 3 years after the date of the actual filing, is the end of the statute of limitations. Okay? If you guys have any questions on that, or you're foggy on that still on how the statute of limitations work, shoot me an email and ask the question. I'd be glad to help you with that, because it can get a little confusing at times. Okay? All right. Let's talk about the thing that scares most people. And the thing that scares most people is, when can the statute of limitations be extended? What does that mean? And what am I talking about? I said the statute of limitations normally runs 3 years, but under certain situations, the statute can be extended. And these are the rules under which the IRS has the ability to extend the statute of limitations, which means extend the time for them to come after you for back taxes. The first one is a huge error, basically, if you really think about it. But the first one says, if you omit an item on your tax return that exceeds 25% of the gross income that you reported. So let's say you reported $100,000 in income, but you left off $30,000 of something that you did during the course of 2016. You just didn't report it. So what happens then? That's over 25% of your gross income, that 100,000 that you didn't report, because you really should have reported $130,000 for that period of time. What does that mean? Because that's the threshold, your statute of limitations has now been extended to 6 years instead of 3. Oh boy, 6 years instead of 3. That's scary, because that's a long time to keep your records. Memories fade, records disappear, all kinds of things happen, and so that's a big window for the IRS to come after you on. The second one is even more scary as far as the statute of limitations. That means, what that says is, if you commit fraud, if you fraudulently, and the purpose behind fraud is to have intent. The first one, you could have made a mistake. It's a biggie. It's a doozy of a mistake if you left off 25% of your gross income from your return. That's a doozy of a mistake. But when you commit fraud, you do that with intent. And under the law, they said, we're going to punish you for that. And the way that we're going to punish you is we're going to keep the statute of limitations open indefinitely. We're going to extend it indefinitely. It never closes if we think you committed fraud. So, what does that mean? It means that a lot of people get caught for tax evasion, because that's a fraudulent return. And so I just threw down some of the celebrities here that have had their share of tax problems. Hopefully you can identify most of these folks. But all of these folks got caught by the IRS under that provision of having the statute of limitations open for a long time, open indefinitely, because they were considered to have done something fraudulent. And probably the most famous, and this is probably well before most of your times, I don't know if you ever even heard of the character, but the character in the lower left-hand corner there is Al Capone. And Al Capone was a famous mobster in Chicago in what's called the Roaring Twenties, in 1920s. And so Capone ran Chicago and killed people, did a lot of nefarious things, and nobody could catch him. The police couldn't catch him. The FBI couldn't catch him. But who wound up catching Al was the Treasury Department. And if you think about it, what happened there, the man who's famous for catching him is a man named Eliot Ness. Eliot Ness was a Treasury agent, and Al was caught for tax evasion. He never paid taxes on any of those illicit gains that he made. And I know that sounds a little crazy. What are you supposed to do? Put the fact that you had, criminal income on a return? Yes. If you had criminal income on a return, you got to report it because it's still income. And if you get caught for not reporting that income, or the government can make a case for you, they will do what they did to Al. They will put you in prison for a long period of time. And so there's some other ones there as well that you can try and pick out which celebrities you know, but all of them had problems for tax evasion. Okay, audit selection. How do we pick you out? How does the IRS come about picking you out? There is a high probability. The IRS has several programs that they use, several computer programs that they use to pick out to your return. And I won't go into detail on all of them that are there, but let me give you a quick rundown of what they are and what happens with each of them. So for example, the discriminant function, it's a statistical methodology, and it's used on the computer. And what the IRS does with discriminant function is they run your return against an average taxpayer in your tax bracket's return. And if they find a big disparity based on the computer statistics, if they find a disparity, they'll run an audit on you. Okay, so that's one. Discriminant function, just a typical computer program. We just throw in a bunch of numbers, and the computer spits out if there's an error or a difference that's actually statistically significant. If they find a statistically significant difference after running a discriminant function, you'll get a little letter from the IRS saying, we want to talk to you. Okay? What else? Document perfection checks. Again, that's another computer program that the IRS runs on everyone's return that's filed. And what it looks for, what I was talking about earlier, it looks for math errors, any issues that you might have in terms of math and doing the return properly. If it finds that, you're going to get another letter from the IRS. And then what the third thing is, the information matching program is another thing that can get you pulled for an audit. For example, if you guys own a home, every year towards the end of the year, your mortgage company, if you have a mortgage, will send you a statement saying this is how much you paid in mortgage interest for this year. That's right on the statement. Well, if you file your return and you just think it would be a good idea to double that amount that was reported by the bank, the IRS will pick that up, because what happens is the bank files information with the IRS as to how much interest you really paid, and then they compare that against your return, and if they see a difference, and especially something like that where the information they have from a third party doesn't match what you're saying, again, they're going to want to have a chat with you about what's going on. So that's the three methodologies that the IRS uses. They'll run all of those tests on one person, or they will run all of those computer tests on everybody that files returns. Now, the good news on this is they are really understaffed. The IRS does not have the personnel they need to run all the audits that their computer programs tell them they probably should be running. They just don't have the staff to do that. And so what happens, they make a selection based again on mathematical probabilities of who they're really going to do an audit on, and it's a very low percentage. It's something, the latest one I saw was something less than 2% of those that kick out because of one of these computer programs that actually get audited. Okay, so when I talk about you get a letter from the IRS, what am I talking about? What's the next step if, say, they pull your return and you're in that magic 2% that they want to take a look at what you've done and talk to you? Here's the types of audits that most likely you will see. The first one is just a correspondence examination, and I don't know if any of you have ever had this or not, and it's the most common audit. And again, that 2% that I say of people that get audited, it gets narrowed down even more with this type of audit. A correspondence examination means they send you a letter and saying, based on the information that we have, you made a math error here on your return, and here's this place where you made the math error. And based on that math error, you owe us X amount of dollars more. Okay? And it's generally limited to just a couple of items on the return, and it's generally limited to mathematical errors. The other place where it could be, you could get them to mention it, is if the example I gave you about the mortgage interest statement, if yours varies from what the bank gave to the IRS, that'll be something that'll kick off and have them send you an audit about that. So that's a correspondence examination. Those are usually really easy to take care of. What that means is that you just say yes or no, and if you agree, yes, it is, and most people do that because they don't want the hassle, they'll send in the extra amount of dollars, and that's the end of the audit. Okay? There's another type of audit that can happen. It's called an office examination. Now, this is the second most common audit. And what that means is you get a letter and they want you to come down to their office. They will ask you to come down to the office, bring your tax records with you, and in the office, they will go through the things that they think either that support their position about you owing more taxes. Now, something else for you that you may or may not know, who goes to that office examination with you? Is it just you by yourself, the lone taxpayer out there? Walking in with your materials going, oh my gosh, I don't know what's going to happen to me. You can do that, but you don't have to. In an audit, an office examination audit, the taxpayer can come in, or the taxpayer can come in with their tax advisor, or the taxpayer can come in with their tax advisor and their lawyer if they're not the same two. Or there's even another option. The taxpayer can send their lawyer or their tax preparer and not go themselves. So you've got several different options that you have when you go to an office examination. You can go yourself, send your lawyer, or go with your lawyer, or go with your tax preparer, who's probably a CPA, or you can send one of the two of them or both without you being there. So those are your options for you. Is one thing better than another? I've been through all of those, and not on the audit side, but on the representation side. I find as a lawyer, because I was a tax lawyer, many times I don't like to have the client there. Why? Because the client gets emotional if I'm dealing with individuals. Now, I've also represented corporations before the IRS, and corporations are a different animal. They're, nobody's going to be there that's getting emotionally involved. And so in that case, I might bring my client with me, or when I was at Manville, I would represent the company when I went to these audits. And again, it's a matter, it's not necessarily a tax situation you have to think about, you guys. It's a people situation you have to think about, and what are you walking into? Okay, so that's an office examination. The next thing is a field examination. Now, this is the most intensive. I've been through, again, when I was federal tax supervisor for the Manville Corporation. And I did their parent company's return, and I did their 40 corporation subsidiaries. I did all of their returns as well, or was responsible for their preparation. I didn't do it individually. And so what would happen there? We were always under audit. Because we were a huge corporation, what would happen there is the IRS people would come out and they'd plant themselves in the company, and they would stay there. When I left, a 3-year audit was still going on that I had no idea when that might wrap up. So field examinations are the most intense. Those are very serious ones, or else it's because what's being audited is so large, like a large corporation, that the IRS feels it's worth their people power to send somebody out to sit there, or a team to sit there and go through records all the time, to make sure nothing's happening, that the IRS is being and somehow losing money that they think they're entitled to. Okay? That can, as I said here, it can last months or years. Okay, what happens then? What's the next step? What happens if, say, the IRS looks at our corporation and says, we think you guys underpaid your taxes by $2 million. Or what if you're an individual, and as an individual, the IRS says, we think you underpaid your taxes by $100,000. Pay up. What happens in that situation? Well, after the audit, whichever kind it is, the IRS agent or agents, the agency itself, will propose adjustments. And they will send you a letter. And if you agree with their adjustments, then you sign a form that's called an 870 form and send them a check and say, yep, you're absolutely right. I owe all that money, or we owe all that money, so we're going to send it in. Now, if you say, wait a minute, I'm not, I don't owe that much money. So if the first part, what we covered is you start with the IRS exam and then you pay taxes due with a proposed adjustment. That's one way to go. The most likely scenario starts off on your right-hand side, which is, I disagree with the proposed adjustment. I don't think it's fair, it's not right, whatever. Then what happens? The IRS generates what's called a 30-day letter. And so what the 30-day letter is about, it says to you, you've got 30 days from the time we've mailed, not the time you receive it, but from the time we mail this letter, you've got 30 days to request a meeting with an appeals officer. And I'm using an individual now. You can ask for an appeals conference. Appeals officers aren't necessarily IRS employees. They are usually independent individuals that work in this process of listening to both sides. It's kind of like a mediator, and they will make a decision on what should happen at this point. The appeals officer then comes out with a proposed, after the appeal, proposed adjustment. And again, you've got a couple of choices. You can say, okay, I agree with the appeals officer who's independent, and I think I got a fair shake out of the appeals officer, so I'm going to pay it. And one thing that the appeals officer is looking at that's different than the IRS agent themselves, the appeals officer considers something called the hazards of litigation. And the hazards of litigation are, what's the chances the IRS could lose? That's the hazard. They're not worried about you. They're worried about, in their hazards of litigation, the possibility that the IRS could take this to court and go to trial, spend a lot of time and a lot of taxpayer money, and lose. So that's one of the major consideration for an appeals officer. So you can, if you agree with the appeals officer at this point with the proposed adjustment, which might be actually to the taxpayer's benefit a little bit because they're thinking about the hazards of litigation, same thing happens. You fill out the form, you pay your money, and you're done. It's over with. Now, let's say that you don't agree with it. You don't agree with the appeals conference, or you just sat on the 30-day letter and you didn't do anything. Nothing happened. You got the 30-day letter and you just sat and forgot about it. And I've actually had some clients that's happened to. They've got a 30-day letter. They haven't said anything to anybody. They just sit on it and hope it'll go away by itself, which it doesn't. And so what happens then is the IRS sends out a 90-day letter. Okay? And what the 90-day letter says is that you have, right now at this point, 90 days to agree with what we're saying you owe, or you have to file in U.S. Tax Court, the U.S. Court of Federal Claims, or you have to file in U.S. District Court. That's your choices at the 90-day letter. So what happens then is it's saying basically we've gone through the IRS agent, we've gone through an appeal, you still disagree with us, you still don't want to pay us the money that you owe us. So now with this 90-day letter, we're giving you time to either pay up or you got to go to court. Okay, and that's it. What's the difference? How many courts can you go to? You got which I just said, you got the tax court, the U.S. District Court, or the U.S. Court of Federal Claims. That's where you can take, if you decide you're going to keep fighting this thing, that's where you can go. What's the difference? Okay, let me explain the difference to you of those systems. The U.S. Tax Court is a national court. The U.S. Tax Court is all over the country. They meet in something like 78 cities, and when they meet in those cities, what they do is they talk about, they'll meet and talk about your case. You'll present your case, and they will make a decision based on that. Okay. The tax court. The good thing about the tax court, while a lot of people pick the tax court to go to, first of all, the judges that sit in the tax court are all tax experts. By tax experts, I mean most of them probably have an LLM in tax because they're lawyers first. And for you guys who don't know what an LLM is, I've got one. And what it means is after you finish law school graduates can choose to specialize in a particular area and go on for another degree that shows their specialty in that area. Mine happens to be tax. And so I went after law school, I went on to get, it's like a doctor who specializes. So a doctor gets out of medical school and decides they want to be a brain surgeon. So they have to go on to school and go on and get additional training for that specialty. Same thing for lawyers. Some lawyers get their LLM, their advanced degree in tax. Some get it in environmental law, some get it in criminal law. There's a lot of areas of law that you can specialize in and get an advanced degree. So when I talk about the tax court being experts, I'm saying that they have a lot of practical experience as tax lawyers. Probably all of them have LLM or advanced degrees in tax, and those are the ones who sit on the tax court. Why is it an advantage for you to do that? Because two things. Number one, the tax court is the only one of all these courts I just mentioned that has a small claims court, which if you might not have known, but you can actually go to small claims tax court if the amount that you're arguing with the IRS about is less than $50,000. You can try small claims court for tax court. Simpler process, less procedure, less baloney, less BS involved if it's under $50,000. The other reason that you would pick the tax court is because you don't have to pay the tax up front. With the other courts, you do. So whatever the IRS says you owe, if you go to the tax court, you don't have to pay it before your situation is litigated. If you go to the Court of Federal Claims or the U.S. District Court, the first thing that you have to do is you got to pay the tax before they'll even let you in the door. So what happens? If you go to the U.S. District Court, you have the possibility of a jury trial. Okay? In district court, you have a chance for a jury trial if that's what you should want. But you got to pay the tax first. The other thing you have to recognize is the judges who are sitting there are not tax experts. They are generalists. They listen to a lot of different kinds of cases. So why would you pick that court? Why would you pick the U.S. District Court to hear your case? Well, again, it doesn't come back necessarily to a tax issue. It's a people issue. If you have something emotional that might play to the judge and play to the jury, well, then that might be the place that you want to go. The other thing is you'll want to look at decisions, and I'll get into doing research in a few minutes. But all of these courts use a system of what they call stare decisis, meaning this argument or this case has already been litigated or this decision has already been made. In the law, stare decisis means we've already decided this. And so you might want to look, if you're going to U.S. District Court, let's say for the District Court of Colorado, what have they decided in the past? Anything like my situation? And how's it come out? Because they will rely on stare decisis in making their decision. So that's the U.S. District Court, okay? And means possible jury trial, got to pay the tax up front, judges are generalists. How about the Court of Federal Claims, U.S. Court of Federal Claims? Most of you probably have never heard of that. What the heck is the Court of Federal Claims? The Court of Federal Claims hears monetary claims against the U.S. government for a lot of different things. If somebody has a claim against the U.S. government for money, that's probably where they will wind up going. What's distinctive about that court? It's a national court again, so representation of that court's all over the country. Again, it's made up of generalists, not specialists in taxation, just generalists. And again, you got to pay the tax before they'll let you in the door to hear your case. So, U.S. District Court, you got to pay the tax. U.S. Court of Federal Claims, you have to pay the tax before you can get in the door to argue. Only the tax court can you go argue your case before you pay any taxes. Okay? So that's the difference. That's where things are different as the IRS appeals transpire and you get into the litigation process. Okay? Again, if you have questions about this, let me know because it's complex. All right. There's what I just talked about, and there's all the examples, or it's the things that I said if you need it for the slides. The judicial system, what happens next? What if you go to the Court of Federal Claims or the U.S. Tax Court or the U.S. District Court? As you can see, I've laid out the judicial system here for you, and what that means is if you lose in these courts, then your next step is the U.S. Court of Appeals. And the U.S. Court of Appeals is right below the Supreme Court. So you better have something that you're really interested in winning because we're not talking about, overnight type decisions. This could be years by the time you get to the Court of Appeals. And then from the Court of Appeals, you go to the Supreme Court. Most times, the U.S. Supreme Court will not give you a writ of certiorari. What a writ of certiorari means is that they won't listen to your case. They're just not that interested in it. So they'll move on and say, hey, it was decided at the Court of Appeals, we're not going to hear you. But that's the system that you'll be in, okay? So now you know what an audit's like. To sum up a little bit, you know what triggers an audit, you know what your ability is in an audit to deal with the IRS itself, and then you know what your opportunities are in terms of going past the IRS agent to an appeal, and from there eventually to a court to argue your case. Now, there's one other thing that I left out that I wanted to mention on this. What if you have no money? What if you really want to settle the case, but you don't have the money that the IRS is asking you for? What can you do then? You can fill out what the IRS calls a Form 656. A Form 656 means I've got no money and I'm making an offer in compromise. What is an offer in compromise? It means I can't pay everything I owe you, but I want to pay you something. I want to make this thing go away. So I'm willing to settle for a portion of what I owe you if you're willing to settle. So I make an offer of compromise to the IRS on Form 656. Most of the time my lawyers will do that for me, or my accountant will do that for me, because now you're getting pretty complicated. The IRS will look at that. Again, they will consider the hazards of litigation. They'll think about what happens if we go on and we litigate this thing, or what if we settle it right now. Many times an offer in compromise is accepted by the IRS for cents on the dollar. I'm not saying it happens in every situation, but it happens quite frequently. So if anybody's ever been through an offer of compromise, let us know. Put it out there for us, and in a statement or something in the discussion section to talk about it. But that's what happens with an offer of compromise. That's for somebody that just doesn't have the money to pay them, but wants to settle this thing and wants it to go away. Okay? So that's the system. That's the system for appealing something. Now, where are we going? This is the Court of Appeal, so you can see it. Colorado, for example, is in the 10th Circuit. I have several of you guys that are in the 5th Circuit because you're down in Texas. I have a student that's in Nebraska, so you're in the 8th Circuit. You can find, and I had a student that was living in Massachusetts, and you can see that that's in the 1st Circuit is where you would argue that case. And so there's all the U.S. Court of Appeal circuits that you will see right there for you guys. Okay, next, doing research on taxes. What are the sources for research? What can we talk about here? Okay, tax law sources, there are primary authorities and there are secondary authorities for tax law. Primary authorities, if you're asked someday to write a tax memo, my advice, Dr. Bob's advice to you guys, is when you're writing that memo and you're citing your authorities, stick to primary authorities. Those include the Internal Revenue Code, the courts that we just talked about, IRS revenue regulations, IRS revenue procedures, IRS revenue rulings. Those are things, and I'll explain in a minute what all those are. But those are primary authorities. So if you ever need to do a tax memo or research a tax problem, that's the first place I would start. And depending on who your boss is, you can move to secondary authorities. But when I was in the situations I've always been in, whenever I've had to do a tax memo, I have to cite primary authorities because I would have gotten in trouble for throwing up secondary authorities. What is secondary authorities? Well, Google. Don't do Google in a tax memo. Google might be right, but it's just not. It doesn't carry any weight if you're dealing with somebody who, like in a Big 8 or a Big 4 accounting firm, and you hand them something and you're quoting Google, you're probably going to get fired. So you don't want to do that. Okay. Tax treaties, rev rulings, rev procs, IRS practices, the Internal Revenue Code, all of that are primary authorities because they all make up the IRS interpretation of the code with examples. And they can give a lot of examples. I always used to go to the tax regs if I was having a problem understanding the tax code, because it can be, if you haven't read the Internal Revenue Code in its raw form, it can seem like a foreign language very easily. And so to interpret some of the things that are in there, if you go to the regulations, it's explained in clearer form, and there are examples that are given. If you go look at revenue rulings, it's explained in clearer form there, and you can see how something has been applied. So it tells the primary authorities, you can work your way, they're all primary, but you can work your way through the ones that, let's be honest, that are more understandable than others. Okay? Secondary authorities, those are tax services. Tax articles in public accounting or one of those. In your book and in the slides that you have, you can see the examples of primary tax authorities listed. There's a lot of them, so I'm not going to go into all of them, but what I just gave you guys are the primary ones there. And most all of them deal with the code. Secondary tax authorities, let me throw this up for you. and this will help make clear. You guys tell me, Internal Revenue Code, I just told you, what is that? Is that a primary or a secondary source? It's obviously a primary source for tax information. Another one, a tax article in USA Today. What do you think? Well, I just told you about Google, so hopefully nobody said it's a primary source. Hopefully you said that's a secondary source, and you'd be right. What's next? An article on a Supreme Court opinion. What do you think? Would the Supreme Court opinion be a primary source? Yes. Would an article on the Supreme Court opinion be a primary source? No. An article on a Supreme Court opinion is a secondary source. Why? Because it's an article. It's not the honest opinion. Okay? A Supreme Court opinion by itself is primary. How about something, and for many of you, you won't know what I'm talking about here, but RIA is a source of information on the Internal Revenue Code and on taxes. It's a great source because everything's in plain English, and it prints out a lot of examples. It tries to give you summaries. It's the Research Institute of America is what RIA stands for. What do you think? Primary or secondary? Secondary, right? Why? Because it's not one of the things I just mentioned to you as being a primary source. How about regulations? Treasury regulations. Of course, primary source. Okay, because Treasury regulations are the IRS itself trying to explain what the heck they're talking about in the Internal Revenue Code and how they think it applies. So if I were doing research, where would I go? I would start probably with the Internal Revenue Code. Read the code first. A lot of people won't do that, but I always read the code first to see if I can understand what they're saying. The next thing I'll do is I'll go to the Treasury regulations and again look at the explanation the IRS has given and try and understand from that whatever my problem is, or see if I can come up with a solution. Because there's examples there, the IRS gives you plenty of examples to see what's happening. So after that, then I would go to the courts themselves, or I might go to, from there I might look at revenue rulings. That might be the third thing I do, and see if I can find any revenue rulings that apply to my situation. And then from that, I'll go to the courts. And I'll see what I can find in the Federal Circuit for Colorado, which I already explained to you is the 10th Circuit, and see what cases have been decided here, looking for stare decisis, looking for an explanation of what I'm reading and seeing how it's been applied under the law, how courts have interpreted the tax code. Okay, that's where I go if I got a hairy problem, if it's really tough. Those are the things that I do. And so if I don't have a hairy problem, if I have one that's not very complicated, but it's still making me think, and I'm having to work on it, what do I do then? Well, then I might go to one of the secondary sources. I might talk about or I might look to the secondary sources because they're easy to understand. So let me go through a little more detail on what I just talked about. 16th Amendment, that gave the United States the ability to tax people. Okay? They can tax under the 16th Amendment. Another place where they can tax, and this again is right now in the current administration, they're arguing about this, is the Commerce Clause in the Constitution. The Commerce Clause says the U.S. can tax interstate commerce. And right now the Republicans and Democrats are chewing at each other about how that applies. But anyway, that's another one. Tax treaties. Tax treaties, if you do international work like I do, the U.S. has tax treaties with many other countries. And those impact what happens. The tax treaty really dictates how the IRS is going to treat revenue earned overseas, what's going to happen there based on the treaty. So that's important too. The Internal Revenue Code itself, it's really the main statutory authority, and I'm not going to go into a lot of detail here, you guys. If you ever get a chance, even during this course, to look at an Internal Revenue Code section, gross income, for example, section 61, look at it to see how it's broken down, to see what a code section really looks like. And that's all I'm going to say about that, because I don't want to go into more detail. I'd put you to sleep if I haven't already. Okay. Tax legislation process. This is how taxes become law, or a tax legislation becomes law, and it works like pretty much everything else. It starts out with a proposed bill that works its way through the House of Representatives There's a joint conference on it at this point. And if the House approves it, it moves to the Senate. If the joint conference approves it, it moves to the Senate. And again, there's talk about it. And this is the steps. You guys can look at them for it to be brought into law. Okay. Judicial sources, the courts. We already talked about the courts, but I want to come back and just for a second talk about how the courts look at the Internal Revenue Code. They have, the courts and the ones that I mentioned, have the ultimate authority to interpret the Internal Revenue Code and settle disputes between the IRS and taxpayers. They are the ultimate authority. The Supreme Court is the highest authority for settling those disputes, although they don't like to listen to tax cases. The Supreme Court will not listen to tax cases very often. It usually stops, if somebody's going to argue a case to the highest level, it usually stops at the Court of Appeals. Okay? The trial level courts. There's 3 trial level courts. I already mentioned this to you as to how this works. The District Court, Federal Claims, and Tax Court. The only thing that I really want to mention here, since I've already talked about all this stuff, and I've talked about stare decisis, what I said is, remember when I talked about stare decisis, I said if you were looking at the District Court, what they would do, or the Court of Federal Claims even, they would look at how the courts have decided the same situation in this district before. So for Colorado, we're in the 10th U.S. District Court area. They would look at prior decisions to decide. The tax court can't do that. If you will remember what I said about the tax court, it's a nationwide court. The judges kind of move from place to place around the country. And so they can't really look at a state and say, gosh, let's see how this was decided in Colorado, and we'll go from there, unless, and this is the way it always works, the person who's arguing the case, the plaintiff, who's arguing against the Internal Revenue Service, comes from Colorado. Then what the tax court will do when they're looking for stare decisis, they will apply the law of Colorado. Under the Golson Rule, what the Golson Rule basically says is the tax court, because it's universal, has to apply the law interpreted by the circuit court in the taxpayer's domicile. So let me say that again. We're talking about all these courts and looking at stare decisis, previously decided cases. And what I'm telling you is for the tax court, because of its structure, they will apply the Golson Rule, meaning that they will look at the Court of Appeals decisions in the state, in the district where the taxpayer who's in front of them right now is domiciled, where that taxpayer lives. So let's say if it's a person from Texas, the decision for the tax court will be based on the federal district court district for Texas. They won't use Colorado, they'll use Texas, and they'll look at stare decisis or previously decided cases in the state of Texas. So that's the Golson Rule. And if you're fuzzy on that, let me know. But one of the things, the upshot of the Golson Rule is this, is that you can have the same court with the same judges making different rulings based on whose law they applied. So you can go to the tax court and say, wow, look at this, they always decided for me. Well, did they always decide for you because the cases you're looking at had a plaintiff from Colorado? Because you better be aware of that you can get out of the tax court differing decisions on the same set of facts because they're applying different sets of law based on the person who's in front of them or the corporation who's in front of them. Okay? Hope I'm clear on that. If you guys have questions, let me know. All right, other sources of information. I talked about the regulations. I talked about the revenue procedures. Revenue procedures have 3 different levels. Revenue procedures can be in final form, temporary form, and this applies to the regs as well, or proposed regs. I mean, temporary and proposed, yes, they're sources of information, but I think I would stick with final regulations, things that are saying this is final, we're not going to do any more on this. What else can we look at? Well, it depends on the purpose. I have interpretive, procedural, and legislative. Again, your purpose or the question that you have in mind can dictate where you go to do your research. If it's interpretive, everything I've talked about today so far, you guys, you follow what I've said today. If it's a procedural issue, then maybe you want to look at IRS revenue procedures because they go into a lot of detail on their practices and procedures in administering tax law. So it won't take the depth of research that an interpretive problem would, but it might be something about procedure that you want to know about. And lastly is legislative, and what that means is there's something where we want to go back and look at the committee reports. I just showed you how tax law comes into effect, how it works its way through Congress. Well, in each of those sessions, if you didn't know this, there are congressional conferences going on about the proposed law. Many times you can go back and look at the legislative history of a proposed law, and it will tell you a lot about what the intent was of the framers of that law. What did they mean by this? And you can use that in court arguments. You know, this is what they really meant. You'll see it a lot of times. How can I give you another example to make that clear? When Neil Gorsuch was appointed to the U.S. Supreme Court, Neil Gorsuch was classified as a strict constructionist. What does that mean? It means that when Neil Gorsuch, as a Supreme Court justice, has to interpret the Constitution on some case, Neil will say, this is what the framers of the Constitution meant. This is what their intent was. And he'll look for, through history and through legislative bills written in that period of time saying this is what the real intent was, so this is what we have to do as a Supreme Court today. Others on the Supreme Court don't look at it that way. They say, hey, the U.S. Constitution was written in 1789 by a bunch of guys back then who don't know the problems we have today. So yes, this is what they kind of intended, but we can play with that a little bit and interpret it as if, Thomas Jefferson and Ben Franklin were sitting here today. How would they look at it? And that's a legislative examination of the issue in front of you. Okay, I'm hoping I'm making myself clear. I know that's a lot of stuff to throw at you guys all at once. Revenue rulings. Revenue rulings don't have a lot of weight anymore. Revenue procedures I talked about. Revenue rulings, private letter rulings. Let me explain what that is. Something else for you to know in this area. When I worked for Manville, many times if we were planning to do something big, planning to do something like make an acquisition of another company, we're going to buy another company, we would ask the IRS in a private letter request for a private letter ruling from them, this is what we're going to do. This is what we think the tax consequences of what we are going to do are. Do you agree? Let us know now before we do anything, because it will save us years on the back end of arguing with you guys about this. Tell us now. We've told you what we're going to do. We've told you the view of taxes we're going to take in it. Tell us now through a private letter ruling what your opinion is, IRS, about what we're planning to do. And tell us the position you would take. It'll save everybody a bunch of time if you do that. Okay? And the IRS would do that. We would get a private letter ruling back, and they would say, based on the information you've given us, our research tells us this is how we would treat your situation. They got so many requests, as you would expect, from many corporations and asking for private letter rulings that the IRS doesn't do it much anymore. They don't spend a lot of time on it. They just don't want to spend the time that it takes to provide every corporation under the sun that's asking them for a private letter ruling an opinion about what they're planning to do. They much rather wait and just work it out later. Okay, some other things on doing good tax research. Let me put these up for you. When you do good tax research, you got to understand the facts first of all. Tax facts can get very complicated, and so when I would do them, and I'm not saying you got to do them my way, and many of you that are tax experts in the class, how you guys maybe did it differently, but I would make flow charts to understand the facts. A lot of the facts I were dealing with were very complex, and I would try to identify tax issues by doing that, and then I would start to do the research I've told you about. But the first thing is to understand the facts. What's really going on here? And then after you do that, after you figure out what's actually happening on the ground, what are the tax issues that might evolve out of that? And then where do I go to do the research to get an answer for this so I'm prepared? That's tax research. And then you document and communicate the results. And again, there's a format in your book about doing a tax memo. I'm not going to spend much time in here doing that or talking to you about that. Okay, what else? These are the more, if you can talk about tax research being fun, this is the more fun areas that you'd want to go. You have annotated and topical research sources. Annotated sources, something like Commerce Clearinghouse tax sources or Research Institute of America tax resources, they tend to have annotated sources of information about tax. And what that means is you can find the code section. They'll tell you what that is. They'll tell you committee reports from what I was talking about from the government when the tax law was being created. They'll give you information on that, separate, annotated summaries. They'll tell you what the regulations are, and then they'll give you a brief summary of all of that. So you can look at an annotated code section under CCH or RIA and get a pretty good idea of what the tax law is. And for most things, most daily stuff, this is where you go. If somebody hasn't asked you to do a tax memo and it's not a real hairy, complicated issue, this is where you go. You look at one of those. Now, those sources are not cheap. Many corporations will buy their own set. Some of it you can find on LexisNexis. You guys have access to LexisNexis. Regis is one of the databases they have. And again, that's an annotated source in LexisNexis that will tell you what you want. Topical is a little different. Topical is just what it says. The issues are arranged by topics, not necessarily by code sections. And an example would be BNA. BNA used to publish a whole set of these little gray manuals that are about that thick, and you could look at in there and find, based on a topic, a fairly quick answer to a question. And these things, for questions of fact or questions of law, those are good sources if it's not real hairy. Okay? So that's the answer. That's where you go for your day-to-day stuff. So I gave you how to do real tax research if something's a very difficult or complex problem, and I gave you how to do tax research on a daily basis when you just need a quick answer to something. Those are the sources for you. Okay? What else can you look at? Well, if you have conflicting reviews, if you're looking at the court, for example, this is one of the last things I want to mention to you before I wrap up. If there are conflicting views, say you've got a couple courts. Say you look at the tax court and you look at the U.S. District Court on an issue and they're different. What do you pick as how you're going to come down or how you're going to decide the issue? Well, there's a hierarchy. The hierarchy I already talked to you guys about. The other thing you look at, what's the jurisdiction involved? Is it Court of Appeals against the tax court? Or is it the U.S. District Court against the Supreme Court? There's the hierarchy. So you look, if it's between those two, Supreme Court and Federal District Court for the District of Colorado, I'm going to take the Supreme Court because I'm probably going to be right if they decided differently than this court. Okay? Look at the age of the authorities. Has this been cited over and over and over again? And once you've done that, that your authorities are up to date, your authorities are valid, then you're in a good position to make a decision. All right, last thing I want to suggest here is I want to talk about you guys' responsibilities as tax professionals. Whether you know it or not, you're going to be subject to a code of conduct. The AIC, American Institute of Certified Public Accountants, has a code of professional conduct, as do lawyers. The American Bar Association, for us lawyers, has a code of professional conduct. And the AICPA has a statement of standards for tax services. Also, the IRS has Circular 230, which I asked you to look at least, and state boards of accountancy also have codes of conduct. And what could be in a code of conduct that would differ between an accountant and a lawyer? Well, mostly in my tax practice, I didn't take contingency fees, but lawyers can take contingency fees. What's a contingency fee? You guys have all seen those ads lately for personal injury lawyers. You see these ads on TV, on the radio, you listen to them till you're almost sick of them. And personal injury lawyers, advertise because it's a lucrative area of the law. Because if you come to them with a personal injury, let's say you got really hurt badly in a car accident, and you've got damages in excess of $1 million, and that lawyer, what he's going to say to you is, I'll take your case on a contingency, meaning I'll try and get you as much as possible. It won't cost you anything up front, but you got to recognize that I get 1/3 of whatever we settled for. Or if we go to court, go to trial, I still get 1/3. So that means that's putting a lot of money in that lawyer's pocket if it's $1 million personal injury case or wrongful death case. Well, the thinking behind the AICPA is accountants don't take contingency fees. And now I'll sit for a second and take a drink of my soda and see if you guys can think of why the AICPA would not accept contingency fees for accountants. Why? Hopefully, the decision that you guys came up with is that an accountant in a tax situation has to be independent. They have to make their decision based on what the law is. They can't be influenced by the fact that there's a lot of money out there. Now, I'm not saying personal injury lawyers are not honorable people, that they are not ethical. I'm not saying that at all. I'm just saying that the possibility could exist that if somebody waives $600,000 in a personal injury case at a lawyer, and he does the math real quickly and figures out, gee, that's 200 grand in my pocket right now. If I convince my client to take this right now, I've got $200,000 in my pocket. Not that that happens, but the ICPA says, we're not going to do taxes that way. We don't want the accountant to buy into a situation where they're financially gaining by whatever tax position they take. So contingency fees for accountants are out. Can't do it. Okay, if you don't comply with the statutes or you don't comply with the professional code of conduct, you can be admonished. In other words, get a nasty letter. You can be suspended from practice. Your license can be suspended, or you can be barred from practicing. And here's some of the penalties that are involved. Generally civil penalties, and lawyers can do this too. Lawyers can be disbarred for acting unethically. But there could be civil penalties. They could pay monetary damages. If a tax practitioner violates a tax statute without reasonable cause for doing it, and I don't know what the reasonable cause would be for violating the tax statute, they could be charged monetary penalties for that. Okay? Other penalties that they could have, they can include going to prison. Because I'll tell you something. Remember my story about Al Capone? Al Capone had a hell of a good accountant. This guy hid money everywhere. And if you ever want to read an interesting story about an accountant, read about the accountant for Al Capone. That guy was an expert at hiding money in all kinds of different places and in all kinds of different legitimate deals. And today you see that a lot in the drug trade, where they will hire unscrupulous accountants to hide their money in all kinds of various ways. If you're caught as an accountant doing that, you're going to prison. There's no two ways about it. And here's some other things for you. I gave you worst case, not worst case. If you as a taxpayer and you as a tax practitioner practicing tax, if you have authority, you did all the research I just told you about, and you came up with a strong position that the IRS didn't agree with, but it's a strong position, it's a reasonable position based on the tax research that you did, then what happens? Based on that authority, you probably won't get stuck with an underpayment penalty. If the IRS still wins, if you make a really strong argument, but it's just not one the court buys, but it's based on substantial facts and authority, then your client might have to pay an additional tax, but they won't be charged for underpayment. Because remember, when you don't pay your tax and it goes for a long time without paying taxes, your tax isn't the only thing that you pay. You also pay interest on the tax you owe, and you also want to pay underpayment penalties if they can show you had no reason not to pay your tax. So it can add up tremendously. And all those movie stars that I showed you, that's what happened to many of them, is they didn't pay their tax, and the interest added up and the penalties added up, and they wound up with having where they were what you would call upside down, where they owed so much money that they couldn't pay for it all. And that's where you do your offer of compromise. Okay? So that's everything there is to do in Chapter 2. If you have questions, it actually is kind of a complex area, and I went through it pretty quick. So if you have questions or you need some additional help on it, you let me know. Otherwise, the next screencast that I will be doing will be on the next chapter that you had to read for week 1, which is Chapter 12, and we'll be talking about other entities besides individuals at that point. Okay? Take care.